Shiller PE near 40, bubble warning or AI supercycle?
The Shiller PE is still sitting near 40, and that is not a normal number. By historical standards, this market is expensive. So why are stocks still pushing higher? Is this the final stage of a bubble, or are investors betting that AI profits can keep this rally alive?
That's the real tension right now. Valuations are stretched, but earnings expectations are still doing a lot of the heavy lifting. As long as companies keep delivering, the market can ignore expensive multiples for longer than most people expect. Let's put this in perspective. The current Shiller PE is around 40.66, which puts the market in rare territory historically. In plain English, stocks are priced for perfection, and that leaves very little room for disappointment.
Now add AI into the mix. The entire market story is being pulled by one big question: can AI-driven growth keep earnings strong enough to justify these prices? If the answer is yes, this rally can stretch further. If the answer is no, the downside can get ugly fast.
And it's not just the megacaps anymore. Smaller companies have also shown signs of strength in early 2026, which suggests the market is trying to broaden out beyond just the biggest names. That matters, because a rally with more participation is usually healthier than one led by only a handful of stocks.
But here's the catch. A high valuation market does not need bad news to fall, it just needs good news to disappoint. If earnings growth slows, or if inflation and policy uncertainty come back, stretched valuations can work against investors very quickly.
The Fed is part of this story too. Markets are still trying to guess the path of rates, and that uncertainty keeps traders on edge. Every inflation print, every jobs report, every signal from the Fed can change the mood in a hurry.
The Fed is part of this story too. Markets are still trying to guess the path of rates, and that uncertainty keeps traders on edge. Every inflation print, every jobs report, every signal from the Fed can change the mood in a hurry.
So what's the bottom line? High valuations are not automatically a crash signal. But they are a warning that this market has less room to disappoint. At these levels, earnings have to keep up.
If AI keeps delivering, this rally can stay alive. If not, the market may find out very quickly how fragile expensive prices can be. That's the real story. So what do you think, bubble warning, or AI supercycle? Drop your take in the comments. See you next time.